Welcome to day two of the boot camp. Now, day two, the main focus of discussion today is going to be risk management. So that is going to be, I'll just kind of type it out up here, risk management, right? We want to make sure that when we're trading, one of the most important things, one of the most crucial things is that we are managing our risks. So in yesterday's training, just to give you an overview of yesterday, yes, yesterday's session was recorded. It is being professionally edited and then it's going to be uploaded. Um, so yeah, we should have that for you soon. Now, when it comes to trading, we want to make sure that we are managing our risk. So in yesterday's training, we went over a few different topics, right? We went over first the technical analysis, getting started inside of the market. Yesterday's training was a basics training. So just to kind of give an overview, I'm going to scroll all the way down to the bottom, so we can kind of go over the overview of what we learned yesterday. Right. So the guide covered fundamentals. There are more indicators and patterns worth learning as you build experience. No single pattern or indicator is right every time, but defined risk management, not clarity, is what keeps a losing trade from becoming a costly one. And then we're looking for confluence, right? So in looking for the confluence, that is where we lead to this calm, cozy method that I was talking about yesterday, where we confirm our bias, we align our entry, then we lock in our trade and we manage our emotions, right? So that's the calm method. When it comes to what we're learning today, in our main topic being risk management, we are going to be covering essentially this last letter of this acronym. So we're talking managing emotions, right? So the only way that you can have proper risk management is if you're managing your emotions, right? Now, we also went over support and resistance. So I'm going to scroll down to the bottom here just to show you guys a few things on this side as well. So we went over support and resistance. This is the main thing that I want us to all remember from yesterday's training, right? In order to identify a support, not every support is valid. That's first and foremost. Not every support is valid. But in order for us to identify a support, we have to have a bearish candle, then a bullish candle. In order for us to identify a resistance, bullish candle, then bearish candle, right? So this is all going to tie into our risk management, okay? So in terms of entry models, in terms of that aligning with the entry, we want to make sure that we're only marking off proper rejections. We want to make sure that we're looking for confluence, and we want to make sure that the weight is on the most recent rejection whenever we're trading, right? So these are key things that we want to keep in mind. Now, what I'm going to do for you guys today to start off, before we really dive into the risk management portion of the training, we are going to go over some of the rules and also some of the indicators, because I know that's something that a lot of you are interested in, is seeing how these indicators work. A lot of you know how Koze works, which is what we went over. So I'm going to start off by just putting this on the screen, so we can all see how Koze is going to be firing off different signals, and how we can take advantage of those signals. So I'm going to go over to the 3 minute. This is what I was looking at last night. And we had a proper trade called out from a support area. So yesterday's training, we went over how we have our daily high on Koze. We have our daily low that's displayed, and we have this middle area of liquidity. And that middle area of liquidity could be large, or that middle area of liquidity can be small, right? Depending on that is determines how we trade that day, right? So if we have a small area of liquidity and we're clearly pricing above it, we're able to look for buy opportunities and get into the market and capitalize off of the longs. But if we're below it and it's, clearly below, then we're able to capitalize off of sells. In this case, yesterday's market for the entire New York session during our entire training, gold was inside of the middle of this area of liquidity, which means that all it was doing was manipulating traders, getting sellers in, getting buyers in, getting them anxious and excited about where the market could go, just to reverse and manipulate them out of trade positions, right? So this is what happened yesterday. Now, as soon as we were able to break out of that zone, we were able to get into a new trade opportunity, which just disappeared. But I wanted to show you guys that it disappeared because we got a new signal called out. But I wanted to show you guys that when we are above our mesh area, because we now finally clearly priced above it in our next session, right? In our Asian session, we were able to price above it after yesterday's New York session. And when we were above it, we got our buy entry signal, and that buy entry signal led to a take profit for getting smashed for over 400 pips in the market. All right, so that was a very, very, very clean Asian session setup that hit TP4 yesterday off of just simply being patient and waiting, right? And we also were able to, some traders were able to capitalize off of this sell opportunity that I called out as well. The sell opportunity was this movement right here. We were waiting for the market to drop below on DJ30. We were watching it when it was up here and rejecting. And we said that, hey, we had a previous resistance. If you guys remember from yesterday's call, we had a previous resistance that was swept. Market broke below. As soon as we got below our area of liquidity, we were able to retest it and get an opportunity to the downside, right? So this is something that some of my students caught yesterday as well. And I posted that inside the group. And then we obviously have another buy called out for DJ30 as well, because we are above our mesh area and we got our signal, and that one as well hit TPs. So this Koze, the original Koze is still very proper, very, very, very proper, and very profitable as well. So one thing that I want to point out with Koze is your take profits, right? So we can clearly see, I told you guys that the market loves to retrace to these areas, right? Loves to retrace either to your daily open, your daily lows, or your daily highs. In this case, we retraced all the way to our daily open. We wicked it, rejected it, and now we are pricing lower, breaking below support. So this is data. This is telling me information. This is telling me that the market is failing to break above the previous daily open area of liquidity, right? So that means sellers are in control in this area. But if we can price above this area, then that's telling me buyers are going to take control, right? And we're going to see this market take out the resistance. So that's all that we're doing, is we're analyzing the market and figuring out what data it is showing us. So to get back into Koze, right, we see that we have our daily high right now. That's right at the previous daily open. We have our daily low, and this daily low barely has any wiggle room, which means that on the daily candle, we priced a little bit lower. We have a small bottom wick, and then the market switched and priced all the way up. So we have a very large bullish candle. Well, we had a very large bullish candle on the daily. Now it's more of like closer to an indecisive candle, because this is going to be a massive wick on the daily. And then I'm going to go over to the daily time frame to actually show you guys how this candle looks. So you guys seen it on the 3-minute, and then this is how it actually looks on the daily time frame. Right, on the daily time frame, you'll see the market opened, came a little bit lower, and then pushed all the way up, and that's where we were able to catch our buy signal. We were able to see it get into that daily open area of liquidity, right? So that daily open area of liquidity on a daily candle is going to look like the daily open on the daily candle, right? So it's very easy to spot these areas. And I'm showing you guys this so you guys can spot these areas on your own, and you're able to see the high probability setups, right? So this was the daily open. This candle on this day opened, pushed higher, rejected, and then came all the way down and closed bearish, right? But this was the daily open. So today we priced lower, priced into the daily open, and now we're rejecting it. So we're going to go back down to a smaller time frame just to see how this market is moving a little bit more intricately. And I am going to Well, first, do we have any questions on Koze itself? Because I'm about to go over the Koze cross now. Just got a few more people hopping in. So welcome to those who are just hopping in. Welcome to day 2 of the bootcamp. We've just gone over Koze and we went over our overview for what we went over yesterday. And now we're about to go over Koze cross. Are we still getting access to Koze as well? Yes, definitely. I'll show you guys that as well. So in Koze cross, I'm gonna break down what we're seeing because we know that we have Koze, right? We know what Koze shows. And now I'm gonna show you guys what Koze cross shows. And then I'm going to go ahead and pull up the rules. Now Koze cross is mainly for gold, the gold market. So let's go here. Koze cross. Right. So with Koze cross rules, you guys can screenshot this as well. If you guys need to, so you guys can always have it. So you're gonna first identify the 3 zones, the daily high, the daily low, and the opening area of liquidity. So the same thing like Koze, right? We see our high, we see our low, and we see our area of liquidity. Once we are able to identify those 3 zones, it would be in our best interest to identify the previous zones as well. So like I said from yesterday's call, we're not going to see the previous zones on Koze Cross because we want to make sure that we're, having a cleaner chart. And we do have an EMA running as well for Koze Cross. So the EMA stays running throughout and you can see how the market moves with the EMA. But then the daily zones are only going to show on the most recent day. So if you want to see the previous days, you're going to have to go back to Koze, and then you see the previous days that we had our levels, right? And then these levels are significant because you can drag these zones out. Like this was the previous daily high on Wednesday. So if we drag out the previous daily high on Wednesday, look how perfectly it smacked into it today, right? From last week, Wednesday, almost a full cycle later, almost a full week later, right? We come back and we touch that exact same price. And then look how we're rejecting off of it now. Right? So this is why drawing out these zones are so crucial, because when you do draw them out, let's say I drew out this one from Thursday and I seen how the market came up to it. And I seen that, hey, the market got a slight rejection off of it, and I maybe took a sell right here. And then let's say the market did not break the support area and I prematurely entered into my sell, right? If you prematurely enter into a sell, why is your stop loss should not be greater than this high right here? Because if the market is rejecting this area, we should see it reject it, continue lower, breaking support. So we don't want to lose too much. So we have to make sure that we have proper risk management, which it boils down to today. And that's what I'm going to be teaching you guys about, right? So even if we took this premature entry, right, no more than a 50 pip stop loss on this kind of a trade, and then you're able to see the next zone, which ended up being up here, where if you got that rejection, you're able to take another opportunity, which would have led to a over 200 pip move to the downside, right? So now let's get into step 2, right? After you identify your zones, and you can identify the previous zones as well, so previous days, your high, low, and your area of liquidity. Now, if the market is above my open area of liquidity zone, we're looking for buy opportunities, right? Same exact rule of thumb as Koze. So we're looking for buy opportunities if we're above our daily open area of liquidity, right? And we are looking for sell opportunities if we're below. It's as simple as that, right? Now, the way that Koze Cross is going to be set up is Koze Cross is actually a limit order. So a lot of times people are saying that, hey, like I'm watching Koze and then I just missed the setup. I just missed the signal, right? I have a surprise coming for you guys as well, because we are coming out with the signals channel that is going to mirror Koze's trades that are getting called out on TradingView. So no more of, oh, I missed the signal, I didn't get the signal. Nonetheless, we are going to have those signals sent out into the community as well. So even if you don't have the TradingView subscription and you're not able to get a alert sent out, then we're still going to have that for you. No problem. So one thing about those signals is that a lot of people might not be um, a lot of people might not be on the charts when the signal is called out, right? So what Cozy Cross is there for is because it's going to call out a limit for you. It's going to call out a buy limit or a sell limit, and I'm going to show you how that looks. All right, this one is a little bit jammed up. Let me see if I can find a better one. All right, perfect. So this one right here. This one is a pretty good one. Well, it's not really a good one, but it is an example. So you guys can see that we have our daily open area of liquidity. This would have been on Sunday. So the market did price with a massive gap on Sunday, right? And in that gap, we ended up getting a signal get called out for the sell. But that sell is going to be a limit at 4009. Our TP levels are going to be 4001, 3954, and so on and so forth, right? So what we're doing is we just have that limit set, right? This would have been called out around 6 p.m. and this limit did not get activated until, let's see when it got activated. It got activated at 9 p.m. 9 p.m. is when it got activated, right? So that is how the limits are set. In terms of this trade, though, we wouldn't be taking this trade. Like I said yesterday, we don't take trades inside of our mesh, but I just wanted to show you guys how it transitions from an entry into, or from a limit into an entry once that signal is crossed over, right? And then you can always check your performance up here. You'll see the daily performance, the weekly performance, and the monthly performance to make sure that you are on a correct time frame that actually, works in your favor. And you also have full control over your settings as well. So you can change your EMA lines if you need to. This will adjust when your signals are getting sent out. So I have it at the 20 and 50. That is for my most optimal trades. But if you change your EMAs, your EMA settings, then your signals are going to change, right? So if you change your settings to, let's say, 50 and 200, then your signals are going to completely change, right? So you can see in the daily performance, it zeroes out because there are no signals with a 50 and a 200. Oh no, it does come up. So now that we have the slow at 200 and the fast at 50, we can see that drastically changed our win ratio, right? We can see we now have a 46% win ratio on the month. We have less trades that got called out, 13 trades. We have 11% win ratio on the week, right? So we know that this isn't a good regime to have. So we go back to our 20 and our 50, and then we go to OK, and then we're going to see that change again in the daily performance. So now we're back to our normal 26 trades for the month, over 2,000 pips caught, which is a lot better, right? A lot better than 300. So that is how we're going to see these limits get called out. Now, the way that it's getting called out, and I'm going to show you guys this by showing you guys the opportunity itself. So this is going to be our blue bubble. We see our blue bubble whenever our fast EMA is going to cross our slow EMA. That is going to, and it's crossing to the upside. That is going to produce a blue dot, right? Now the exact opposite, if our fast EMA is crossing over our slow EMA to the downside, we're going to get a red dot, right? Red dot. So the rule of thumb is that if we can get a blue dot, what we're waiting for is we're waiting for the retracement, right? So we drag this out. Let's say we mark this off, and then we have this as our order block zone, so it can extend. We are waiting while we're seeing this blue dot. This blue dot would call out a signal that will call out a buy limit. And we're watching the market. Soon as the market gets back down to that level, back to our blue dot, this is going to be our entry, right? Now, in this case scenario, we didn't get this buy entry called out because we got this massive gap formed, and that was after the end of a session. So we crossed over from, Friday, London, New York session, or Friday, technically Asian session. And then this is Sunday. So this is like a whole weekend has passed. So that's why we didn't get this buy call out. But if you know what you're looking for, if you know how to analyze the market, you're going to be able to catch this buy opportunity, right? So this buy opportunity was here. And this would have been a beautiful trade over 300 pips with barely any drawdown, right? And it's the same thing for these sells. The ideal sell opportunity is going to be after a red dot. Now, what you want to see is you don't want to see, the market come into these areas very quickly, because if it's coming into it very quickly, then chances are you're going to be faked out, right? So you have to watch and be very cautious, and wait for the rejection itself. If you don't see a rejection of that level, then there's no valid trade. But in this case, right, we can see the market came up to this level, up to our red dot. We did reject. We did get a confirmation by getting a bearish engulfing signal. Remember yesterday when we went over a few of our technicals, we got our bearish engulfing is going to be when a bearish candle ranges, completely engulfs the day before it, if it were looking at the daily time frame. But essentially what we're going to see is a small bullish candle and then a larger bearish candle. And that's exactly what we see here. So this would have been our confirmation, our rejection of our red dot, and then we were able to get these smooth sailing sells all the way to the downside, right? Now, this is over 200 pips on this trade. So this is by using Cozy Cross. Cozy Cross is going to show you these levels time and time again, and you're going to be able to take advantage time and time again, right? If you see the proper rejection. So I can go back. Let's see, even here. This is another example, right? Perfect setups when you see these blue dots and you're seeing a lot of volume. Typically, you want to see it leave this area after the blue dot for at least the rest of the session that it's in, right? And you want to see it retrace in a different session. That's typically how market flows. We always flow in sessions, we flow in times. So when we see this happen and then we see this rejection and this bullish engulfing, another buy opportunity for us in the market. Right now, you don't have to sit down and search for these setups. Cozy is going to call out buys and sells, and then that's when you can see them called out here. So for the month, you can see 26 buy calls out, or buys or sells called out, and this is going to be on the 3-minute time frame, which you can adjust any time frame as well. But this is just so you guys can see how the markets is flowing on these EMAs and how to take advantage of those EMA flows. So I'm going to leave this real quick and I'm going to remove all of my drawings because we are slightly after 9:30 and I want to see where the market is. All right, cool. So we're still inside this consolidation, but we did break below our EMA. So now let's get into it, right? Let's get into the risk management portion of understanding these market flows and understanding how to take these trade signals, right? So a rule of thumb and why Cozy Cross was created was because a lot of times people have been asking me in trading Cozy, right? I'll turn Cozy on real quick. A lot of times people have been asking me in trading Cozy, hey, what TP should I aim for? How do I know when I should exit the trade, right? Exiting the trade is the most important thing. It's more important than entering it. Because if you enter and you don't know where to exit, then you're probably going to lose money, right? That's just a simple fact. You have to know where you want to exit the market. So Cozy Cross helps with that because Cozy Cross is going to give you the EMAs and you're going to be able to see, okay, if we are above our EMAs, then we're good to keep holding our trade if we are in a buy. So for in this case, if I were to go and do a bar replay, and we were to see this. In this case, why I said that this trade was like kind of jumbled up and I didn't want to show this example is because we got our blue dot and then we got our signal called out and then the market immediately hit into our signal and immediately entered us in. It was still a valid setup in a sense, because we had just kind of swept this sell side liquidity. So we had a little bit of sell side liquidity right here that got swept, and then we continued pricing higher, giving us some indications that we wanted to break the resistance. But nonetheless, just to show you guys how this works, if I'm in this buy setup, I'm gonna hold this buy as I'm continuing to price higher above this EMA, right? Now this next trade that got called out, this is gonna be a Koze trade. So Koze cross got called out down here, and then Koze got called out up here. So if you have both of them, then you're able to get some re-entry opportunities, eh? Beautiful. Both of them hit TP4. And why did both of them hit TP4? Because we're staying above our EMA, right? And that is how we hold our trades. Now, as soon as we break below our EMAs, guess what we get? We get a bearish dot. We get a red dot. This tells us, hey, maybe we don't want to look for any more buy opportunities. We should start looking to exit our position, right? So this is why Koze cross is so crucial, because you're going to get these indications and it's going to save you from losing money or not capitalizing off of the gains that you already had, right? So that is why I wanted to show you guys Koze cross in learning about risk management, because when you're entering in a position, let's say I'm entering in a long position, it's easy to say, yeah, I'm going to hold my trade below support, below support, below support. But then if you don't know when to stop buying and you don't know when to stop keeping your stop loss below the support, you're going to end up taking an unnecessary loss eventually. And that can lead to multiple unnecessary losses, because then you can say, okay, maybe this is a support, I buy here. Then the market breaks again and then breaks again. And you keep taking these buys as the market is dropping, right? That's called buying the dip when the dip keep dipping, all right? We don't want to do that. We want to make sure that we are on the right side of the market, and Koze Cross is going to make sure of that for us. So if we're looking for buy opportunities, ideally we want to be above our mesh, right? I'll bring up the rules again. We want to be above our mesh, and we also want to be above our cross, right? Above our mesh and above our EMAs, above the cross. So in this case scenario right here, we get the market to break above our mesh, and we get our bullish, indication. If you have a little bit more experience in the market, you don't have to wait. Like I said, understanding when you can wait, you get a better trade opportunity, right? Low risk, high reward. This would have been a perfect setup, but you don't have to necessarily wait if you understand market flows, right? So if you can understand candlesticks, you see that we have a bullish indication. You see we're above our mesh. You see we're above our EMAs. That's 3 confirmations for our bullish bias. One more confirmation is just simply a candlestick, right? We see our bullish engulfing candle right here. We can take a trade entry right there, and we can capitalize off of a nice, beautiful 250 pip move to the upside, right? Simple. So this is why understanding the EMAs, understanding the flows is so important. If you have any questions, let me know. I know I've been kind of spitting so far for the morning, so let me know at any time. So let's keep going. When the ball is blue, wait for a retest and confirm the bullish directional bias, right? So that confirmation is going to be right here. When we do retest, we're going to wait for our confirmation by the market breaking back above our EMAs, right? Because if we retest this level, but we're still below our area of liquidity, we're still below our EMAs, then what's stopping us from continuing bearish, right? So we don't want to just impulsively enter. We want to wait for the rejection and the proper indication, all right? This would have been the first bullish engulfing right here, but the ideal entry would have been waiting until we came back down and retested this area right here. Why was this the ideal entry over this? Because of this massive area of liquidity. We did not price higher above it until this right here. We ended up sweeping this high. So this was kind of like, a shakier opportunity. I would have probably waited, still not gotten down here. But let's say you did get in. Let's say we got another blue dot. You got the market to indicate that you're going higher. So this is a technical valid setup. The only thing is it's a low probability setup because we're below our mesh. If we were above our mesh, it's high probability setup. So if we wait patiently, we would have had to wait a long time, right? Because there was a lot of manipulation. But if we waited patiently, we would have been able to wait until this next session over here, where we were above our mesh and also above our point of interest, our EMA. So this would have been our buy signal right there. Once again, another 200 pips caught, and then immediate reversal right after, which is crazy. But that's just the power of Cozy Cross, guys. That is the power of Cozy Cross. When it comes to risk management, it is elite because it can show you your exact areas of where you would want to exit, or potentially look for you to close out the trade. So like I said, Mali, when you were in the buy and I said, hey, you might want to close that out because we're at the resistance. Now we're dropping. What else could have told you that you were at a resistance? We got a red dot, right? Multiple red dots, 2 red dots. Right? So that would have been another indication, and you would have been able to exit that trade or make your analysis without me even being on the call or without me being there. So you're able to do this on your own by just having these tools, right? So we want to avoid entries when the market shows no clear price action to the left of the desired entry, right? This is a major, major, major one. And this goes across the board for any position that you're trading, any strategy that you're trading. You want to avoid an entry when the market is choppy to the left, right? Every single time. So, example, over here where we were getting all of these buy signals called out, but we look to the left and it's just a bunch of choppy movements. We're not getting into any of these buy signals or sell signals, right? We didn't even get into this one. Why? Because it was still choppy to the left. But once we did break above and we're able to say retest this area and we can clearly see that, hey, we are breaking resistance, we can then get in for our buys, right? So that is all that that's saying is we want to wait for clean price action to the left. Another example is going to be something like this. So if you're understanding these daily lows and daily levels, then you see that this is a daily low. Market comes down to it. If you look to the left, there's clean areas. There's nothing over here to the left, right? So we can say, hey, once we do get our indication, we should be able to get into our buy position, right? So that is what we want to see. We don't want to see, you know, us looking at the market. Let's say we're looking at the market during this time, right? Let's say we're looking at the market during this time in this zone. Then if we look to the left, right? If we were to drag this over to the left, what do we see? We see all of this wick rejections, we see breaks of lows, we see the market retesting, but we see a lot of resistance in this area, right? So we see a lot of resistance in this area, but it's still choppy movements. That means that we don't want to just sell when the market gets here. We want to wait because the market is going to react sharper off of areas where there is no activity to the left than it does when there is activity to the left. I'll repeat, the market is going to react sharper when there is no activity to the left versus when there is activity to the left. So in this case, there's activity to the left, but then you drag this up a little bit more, and then look what happens. There's no activity to the left anymore. That's where the market reacts. That is where the liquidity is. Why is the liquidity there? How do we know the liquidity is there? Because money moves this market. And if this market is going to move from 4,094 all the way down to 4,040 within the matter of 2 hours, 3 hours, then that's a whole lot of selling pressure. That's a whole lot of volume, a whole lot of liquidity. That is what it's called. Ultimately, it boils down to liquidity. Where is the liquidity? Because that is where the market is going to price back to collect that liquidity and then make its reaction. So a very, very crucial rule of thumb to make sure that you are not entering into trades when there is choppy movements to the left, right? So With that being said, now we have now ventured into the topic of liquidity. So I'm going to show you guys, and I also want to see what's going on DJ30. So it's just perfect timing. Okay, DJ30 is moving nice. DJ30 is moving nicely. So we came back down to the entry, retested it, and now we're rejecting it again. But we have all of this massive rejection off of this resistance right here, off of this previous daily open. I do believe we're gonna break it though. I believe that we have enough strength to break it. What I would need to see happen though before we can break it is I would need to see a resistance broken. We have not broken any resistance yet. So there's no opportunities for the buy. And we also have not broken any supports yet. So there's no opportunities for the sell. So I'm gonna just remove both Koze Cross and Koze and then show you guys what I mean. So right now in DJ30, we can see that this top area, this is going to be our resistance, and this bottom area is going to be our support. I know some of you have been trading with me for a while, so you're gonna be familiar with this tool. I feel like Sandy is probably gonna be the first one to know what this is. But we got our do not trade area, right? Our do not trade area. If we are in between a support and a resistance, there is no opportunities for us to get into the market, right? This is live market training, guys. Today is more of a interactive with the market kind of training. I have some slides to show you guys, but I want to make sure you understand this concept because this is where risk management takes place. It takes place on the charts. It takes place in understanding the market movement, right? So we do not want to trade in between support and resistance. We want to wait until the market is at a level of support to buy or at a level of resistance to sell, right? So that is crucial. So right now we're waiting until the market either breaks this support, gives us our indication that, hey, we might be continuing to price lower. I have this level marked off right here because I really want to see us tap into this. I really want to see US 30 do this right here. Tap into this, sweep this area of liquidity, and then spike all the way back up, and then shoot up, shoot all the way back up. This is exactly what I want to see happen on DJ30. I'll take a little screenshot of that and I'll post it inside the group. But that is what I want to see happen on DJ30. Now, what I want to show you guys, because I said we are getting into liquidity, what I want to show you guys is a tool that I'm excited to show you guys because this has been one that I've been saying that I wanted to work on for a while. And I finally have gotten it released or accomplished, and that is going to be Koze 30. And Koze 30 also works on NAS. So we also have Koze 30 for NAS 100. I have not checked it on the S&P 500 as yet, but it will be good to check that as well. So Koze 30, we also have our daily performance tracker up here. So you're able to see, hey, we took 3 trades today. We got a 67% win ratio, which means 2 trades won, 1 trade loss. All right. For the week, there's 5 trades. Today is day 2. We're at 210 pips up with an 80% win ratio on the week. All right. So these are very, very nice, beautiful setups that you're able to take advantage of with high win ratios. Now, how this works is Koze 30 is going to show you your areas of liquidity. It's going to show you your areas of liquidity automatically. You don't have to go and searching for it. It's going to show you, hey, there's liquidity here, there's liquidity here, there's liquidity here. Watch for these areas. If there's a lot of boxes in one area, then we technically don't want to look for those trades in those areas, right? We want to wait till the market gets away from these areas of liquidity because where there's liquidity, there's manipulation, right? But what we can do as well is we can take advantage of these sells and buys if we understand market flow. So in this case scenario, we have 2 areas of liquidity, right? We have above and below. If we have liquidity above and we get an indication to be able to get into a buy position, we can buy targeting the liquidity above, vice versa. If we are above an area, or if we're if we're below an area of liquidity and we have a target of area of liquidity below, then we can look for sell opportunities to hit that next area of liquidity. So in this case, we were bouncing in between, could have taken advantage of buys and sells and buys and sells and buys and sells, and then we got a break, right? But in most case scenarios, what I want to see and what's most important to me is going to be these zones right here, right? Where we have this zone marked off as a beautiful area of liquidity, right? And then we see a massive rejection of that area. That massive rejection of that area can lead to a downwards move. So we can take advantage of something like this, which is a nice 150 pip move. It is just a pullback, but if we're pairing this up with, where did my indicators go? If we're pairing this up with the Koze cross, right? So you can pair these indicators up together as well. And if we're pairing this up with the Koze cross, then what we can see is, hey, we rejected this area of liquidity, right? Now, can we get an entry and then see where we're going to take our profit? If we're taking our profit, we're ideally taking our profit at the EMA. Right? So we can take our profit at the EMA because there is no area of liquidity below. Like I said, if we're below an area of liquidity and there's another area of liquidity below, then we can take those sells to that lower area of liquidity. But if there's no area of liquidity below and you still want to take the position, you can have multiple trades, indicators set up where you can see your EMAs, you can take advantage of that sell, and you can capitalize off of a nice 100 pip move to the downside. Right? Beautiful trading setups. As well as over here, right? We can see right here, we have a area of liquidity, massive rejection, an absolutely beautiful rejection, actually. We swept this low, rejected. If we took advantage of this long position right here, we caught another 200, 300 pips to the upside with barely any drawdown, right? Now, what we would be targeting is going to be the next area of liquidity up here, which would be about a 500 pip move. We got just below it, which you definitely would have capitalized off of some trades. You should have capitalized off of a take profit hit before that 500 pip. So if we got at least 430 pips, you should have taken some profit out. So I'm not mad at this one, right? But you can use these areas of liquidity as reference points to see where you would want to get in or where you would want to get out of a position, right? So an example again is over here where we had all of this accumulation, right? We had an indication to go up, market came back down, retested this area, and then accumulated, manipulated. In this manipulation, we formed a area of support. And once we broke that area of support, we melted. Now, I'm going to show you guys a strategy that basically uses trend lines, something like this. Oh my days, this is going to be the elite training of the century, I swear to you guys. Um, but I'm going to show you guys a strategy that uses trend lines, and you're going to be able to see, hey, if we do break our trend, we're below our area of liquidity, we're below our EMAs, this is going to be giving us clear identifying directional bias. We're going to see, hey, are we dropping lower? We're going to be able to take that position. And I'm going to break down exactly how we're going to be able to capitalize off of positions like this, off of positions like this. Let's see here, this one right here, right? When you see a trend break, these are trades that you can get into, but I'm going to teach you guys how to find these trades and how to actually properly take them. So I think we have a few questions. What is the best time frame for Koze cross? So Koze cross, the best time frame right now is going to be that 3 minutes. I'm just going to remove all of my drawings so we can see the market again. It's going to be the 3 minute, and the 15 minute is the two most profitable at the moment for Koze cross. But like I said, you guys always want to pay attention to your performance data in the top corner. You also want to pay attention to when you're able to adjust your trades, so then that way you're able to see if the market is going to perform better or worse depending on your time frame. But for right now, for my strategy and how I trade it and my settings, 3 minute and 15 minute are the most profitable on Koze Cross. And then Koze 30, we got the 3 minute, the 1 minute that are the most accurate in readings for Koze Cross and for Koze 30. Right, so all of these trades and all of these indicators are going to be specialized for these lower time frames between the 1 minute, the 3 minute, the 5 minute, and the 15 minute. Anything above those levels, it distorts the information. And the reason for that is because we are intraday traders. I trade every single, not every day that I trade, but I watch the markets on the daily time. I watch the intricate movements of how price is moving for this day. So if we're going into the 1 hour or the 4 hour, there's a lot less data points for us to be able to take action off of. And Koze is analyzing these data points. So if there's less data points, then there's less reactions, less entries, and just a less probability of being profitable off of that signal. Right. So what we're gonna see is, I'm gonna go ahead and remove these as well. So the most important thing that I wanted to show you guys, or for you guys to remember, on top of showing you guys the indicators, is understanding how to use them in a way that you can manage your risks on your trades, right? So we got why Koze 30 not suitable for gold. It would end up identifying liquidity. It's not suitable for gold. I'll show you why, because gold's areas of liquidity are just way too massive. They do work, so you can use it essentially, but look how large these zones are, because I have it with a specific setting that's going to be for US 30. So these zones just end up being way too large. Now they do get some crazy reactions, because you can see that we priced all the way up to this level and then reacted down to this level, priced back up to this level again, reacted back down to this level again. So we can see that it does work. It does work very effectively, but essentially it's too much for a beginner trader. So I wouldn't encourage anybody, new to be trying to look at Koze 30 on gold, because it's going to kind of confuse you. So I would only, have this for experienced traders, and just use it for DJ30. And ultimately the better position anyway, because we can see here 7 trades on the month, 43% win ratio, versus Koze on gold, the exact same time frame. You have, well, it's not going to show you the monthly, but it's going to show you 3 trades on the day, 33% win ratio. So you're losing more trades, but you still have a profit, even though you've lost more trades. So Koze V2 is going to be the prime for this, for gold. Now, what I want to show you guys now, now that you guys understand how Koze works, I'm gonna just drop these 2 right here so you guys can take screenshots. I need you guys to understand 3 things. 1, how Koze Cross works. All right, so let's just go over here. 2, need you guys to understand how Koze 30 works. Right? And 3, I need you guys to understand how Koze works. Koze is the number 1. This is the first thing that we've done, right? Is Koze. So Koze Cross rules we went over. Koze 30 rules is going to be time frame 1 minute and 3 minute are the most profitable. Acknowledge every area of liquidity before entering a trade. Look at that beautiful move. Oh my days. Yeah. So identify every area of liquidity before entering a trade. All right, cool. So we have Koze 30 now. Bet. All righty. So what we're gonna do, we're on DJ 30 because we wanted to see. The rule was we want to wait until we mark off every area of liquidity before we get into the trade, right? So liquidity zones are targets for take profits or areas to avoid entries. You have to acknowledge all of them in order to do so, right? And what I was explaining to you guys is that one thing about Koze 30 is that we did hit TP Then we came down and hit stop loss, but that doesn't mean that the directional bias has changed. So if we come back to the entry, we can enter again and take this position again. That is the difference between Koze 30 and any other Koze system that we have. Koze 30 is going to be able to hit stop loss, but it's not going to remove the position unless the directional bias has shifted. So if the directional bias is still bullish, it's going to stay in that buy signal. This stop loss simply just means that, hey, we took profit, then the market dropped below a level that we want to be in the market for, right? We don't want to risk this much. We don't want to hold the position just because we think it's still bullish. No, exit your position, take out your loss, and then wait for another entry, right? Wait for the market to get back to entry. You would have been able to capitalize off of this trade for a second time, taking over 100 pips out of the market. Right, so first trade hit TP1 for 50 pips. If you didn't close this trade out, and let's say it dropped and it hit your stop loss at 50 pips, at 40 pips, sorry. So we have a 50 pip TP1 and a 40 pip stop loss. So these are very high probability, low risk trading signals, right? But let's say you hit that stop loss, you hit TP and you didn't close it, you were greedy, right? Let's say you want to go for TP3, right? So hit TP1, didn't close it, hit stop loss. Okay, alhamdulillah, you finally you took an L, right? That L led you to minus 40 bucks. Minus 40 bucks with a buy limit, a buy stop entry, right? And now we're looking for a recovery trade. So we don't want to aim for that TP3 anymore. Let's say we're just aiming for TP2 so we can get that 40 bucks back plus some profit. You hit that TP2, that would have been 100 bucks and you would have made $60 off of this trade. All right, makes sense to everybody? All right. Now I do have the special sauce. Special sauce for Koze rules, for Koze 30 rule is going to be identifying your 1 hour zones. I'm going to show you that right now. I'm going to show you that right now. I'm going to remove all these drawings and let's drop over to the 1 hour time frame. So remember how I said that Koze works best on lower time frames. This is going to be for your entry models. But that doesn't mean that you have to analyze everything on the lower time frame. We can see the bigger picture when we're looking at the market. Looking at this bigger picture is going to allow you to see something like this, right? Where we can see, hey, there's a lonely area of liquidity right here that has not been tapped into, right? I'm going to go through a few of these liquidity areas, right? In this case, I'm going to show you guys this one first. This lonely area of liquidity that has not been tapped into. And then we're going to go ahead and draw the box, right? We draw the box and we drag it out. And look where the market reacts. Oh, it gives me chills. This is such a perfect position. Now, if we're going to wait and be patient, then we wait for this 7 a.m. hour candle to close with this rejection, right? And this would have been on the 14th of July. This was a Tuesday. So let's drop back over to the 14th of July on the Tuesday, and let's see how we would have been able to capitalize off of a position off of that rejection. Right, so this is your golden areas, right? Your golden areas are going to be your 1 hour zones. When we drop into that 1 hour zone, what do we see so perfectly? Oh my goodness. We see a perfect swing low off of this level, followed by a perfect bullish engulfing. This is what you call beauty. This is what you call cheating. This is cheating in the market. We have our stop loss right there, about 80 pips, and we're able to capitalize off of a 1 hour move to get over 500 pips in this market. The power of Koze. The power of Koze. All right. Now let's drop back over to our 1 hour and let's go over another example, right? Another example is going to be right here, right? So this is a smaller example, but I'm going to show you guys this one here as well. So in this case, we have this level right here. This was slightly before this trade right here. So this would have been on Friday, the previous Friday, July 10th. That's my Bahamian Independence Day. Whoop whoop 242 to the world. July 10th on Friday, we got another rejection of an area of liquidity on the 1 hour, and this would have been 10 a.m. So we go ahead and mark this off, right? And then let's drop over to our 3 minute and let's go over to July 10th. Let's see what happened on the Bahamian Independence Day. All right, that's our first indication on Bahamian Independence Day. This was the 10 o'clock area, so it didn't hit actually until after 10:30. 10:30, we got this rejection of this area on the 3 minute. And if we waited for our bullish engulfing, if we entered off of the rejection, we're golden, we're beautiful. But let's say we waited for a bullish engulfing, we would have got in right there, and we would have been able to have our stop loss right there, about 70, 80 pips, and we would have been able to capitalize off of a 160 pip move to the upside, right? So this is the power of that 1 hour zone, and you can go back when you guys have access. You guys can go back and look at the 1 hour, then go on to the smaller time frame, and just keep going back and forth in time and really solidifying your trading strategy and your trading style using Koze 30 or using Koze Cross or the combination of both, right? Or all three, right? Because they're going to show you the same things. So just wanted to show you guys that, and now we have passed the 1 hour mark, but I did want to show you guys that because Koze Cross and Koze 30 are coming out very soon. August 1st is when you guys will have access to all of the indicators, but let's run it. I'm gonna go over now. We're gonna get into the actual meat and potatoes. There's two things that I'm gonna show you guys for today's session. Today is gonna be more of an advanced session. So we don't have any signals, but we have this DJ30 signal that got called out. Gold, we don't really have anything. Gold is kind of just playing, dropping back down. It's getting to this entry. This is a Koze 30 entry actually. So Koze 30 does the same thing. We're gonna get our entry calls out, are gonna be right here. And then we see that price just kind of came back up. We retested our entry and now we're pricing higher again. So we'll see if we stay above this area of liquidity, but right now gold is just inside of this range. So I'm gonna dive into the more advanced setups, and the way that we're gonna do this is through these slides. So there's two things that we're gonna be going over today, right? So this is the actual bootcamp training. Everything else was kind of just going over a little bit of how to use the indicators and using it for risk management. But this is going to be the actual training, which I'm going to be sharing with you guys fair value gaps and liquidity voids. I'm also going to be showing you guys a super sick trend breaking strategy that I was referring to earlier when I showed you guys those trend lines, right? So starting off, let's go through the fair value gaps and liquidity voids. So before I jump into it, let me know who all is familiar with fair value gaps. It's just so I know, how advanced my crew is right now. I'm gonna get this set up. All right, there we go. Perfect. So let's say I'm pretty familiar with them. Perfect. So what is a fair value gap? So for those of you who don't know, a fair value gap, or an FVG is what we call it, you'll hear me say it a lot, forms when price leaves a level behind so quickly that almost no trading happens there. Just a sharp one direction move, the gap is trading active, or the gap is in trading activity, is an ineffective, and price is statically likely or statistically likely to come back and fill it before continuing on its way. So what we see happen with a fair value gap is we see the market reacting with no opposition, is what we call it, right? So the market is going to drop down if it's selling, and it's gonna leave a gap if there's no opposition, if there's no buyers to push the market back up into that gap, and vice versa for the buy. If the market is pushing higher, so in this example, we see the market pushing higher, and it leaves a gap because there's no sellers to oppose these buyers, and that's why the market keeps pushing higher, right? So an FVG becomes far more useful once paired with order blocks. So we're going to get into a little bit of that as well. But I don't want to get into order blocks just yet because that's going to be a little bit too much for today's training. But fair value gaps, we have to know that this is going to be a part of our alignment part of our column method. So we're going to confirm and then we're going to align, and the fair value gap is a part of that alignment, right? Now we have our breakaway and measuring gap. So what is a breakaway fair value gap? A breakaway fair value gap forms when price breaks out of a consolidation range with real force. So if you've been following me for a while, one of the first ways that I taught my students how to trade is by identifying when the market breaks a area with volume. I've always told you guys that volume, if the market doesn't break this area with volume, then it is more than likely going to be a fake out. We don't want to see us getting into these kind of trades because there's no volume to back it. There's no volume to push the market in that direction that we're looking for it to go, right? So we want to make sure that with breakaway fair value gaps, there's going to be a break out of a consolidation area. And then we are going to see a measuring fair value gap, which forms just after a breakaway fair value gap and tends to stay open even longer. Heavy institutional order flows usually surround it, pushing price firmly in one direction and leaving little room for a retracement. All right, so a breakaway is going to look like this, where we have our consolidation, then the market breaks away from it, right? Once it breaks away from it, we're going to get a small little pullback. Maybe we do fill or tap into this fair value gap, and then we're going to have another, break of a low. And then we're going to see that measuring fair value gap, which it shows a little bit more clearly over here, where you can see the actual market move, right? So seeing it all in one chart, is going to be a lot more simpler. So you see the accumulation right here, which is the same thing as up here. And then that first breakaway, that first fair value gap that breaks below that support, right, is going to be that breakaway fair value gap. Now we know that it breaks below support because this SMS is going to be really like SS L is the same thing. It's going to be the sell side liquidity. This is buy side liquidity up here. So it's the same thing down here, sell side liquidity. And as soon as we break below it, and then we retest into this breakaway fair value gap, that's when we're able to push lower, creating another fair value gap, and then push even lower, creating a measured fair value gap. Now, this is where we're saying that price typically would just continue in that downwards direction after the measured fair value gap, right? So we can see, hey, fair value gap retest, fair value gap retest, measured fair value gap gets left behind. Is that clear for everybody? Right, so the measured fair value gap is what's get left behind. So if you see that, after you see the market first accumulate, we see a manipulation, we see a break of structure, we see that, hey, the market is actually going down, and then we see a measured fair value gap. That is your indication that, hey, we might be able to get into this trade signal. We might be able to take advantage of this trade opportunity, right? And then you have consequent encroachment, which is going to just basically be 50% level of the FVG. So that's going to be shown right here, where we have this is the full FVG, and then this dotted line is the 50% of it. That's really all that means. This is the mean threshold is what we see here. So we also have, we want to be able to pay attention to that because the market doesn't always fill a fair value gap. Sometimes it just mitigates it. And that mitigation could be at that 50% level, right? So that's why that level is important. And then we do have also liquidity voids. So what's the difference between a liquidity void and a FVG? Essentially, they're the same thing. right? We have an imbalance in the market. We have an area that needs to be corrected, right? But a liquidity void is a wider version of the same idea as an FVG. So the larger candles with very little trading activity behind them as price moves sharply in one direction. So this is an example of a liquidity void. You've seen this time and time again on the live markets, and I'll show you guys as well. This would be an example of a liquidity void, right? A lot of people, like there's many different kinds of FVGs. A lot of times you'll hear me just call this an FVG, but it's because I don't want to confuse people, because these are more advanced topics. But this essentially, this form of fair value gap is a liquidity void. It's one massive candle that wiped out what was previously 4 hours of consolidation, got wiped out in 3 minutes, right? Liquidity void. We happen to have a liquidity void to the upside first, right? This was a liquidity void to the upside, immediately getting filled, and then another liquidity void to the downside, right? So this is what we say whenever we see these voids, we want to be cautious. We want to wait until the price gets back into that area and mitigates that void, right? So to go back over here, we see this void right here was created, and then we came back up and we mitigated that area before getting a little reaction off of it. Now we could have priced higher again and continued to break the resistance on this kind of a trade. We don't see what happens for the rest of this market. I'm sorry. We don't see what happens for the rest of this market, but we can see that, hey, we dropped down, we had a void, and then we came back up and priced into that void, right? So that's the same thing that happened here. We dropped down, we had a void, we came back up and priced into that void. When we came up and priced into it, we did get some rejection, but then ultimately we broke above and we knew that, hey, we collected this liquidity that was in this liquidity void. There's obviously liquidity in a void, right? So if we collected this liquidity, if we collected this money, where is the market trying to go next to get money? Because the market is a jonsa. It's a beggar. It always can be going from money. It's always going towards money. So if the market now collects this money, we want to see where is it going to take this money and where is it going to go and collect the next forms of money, right? It's a gangster and it collecting money from everybody. So we have this nice rejection and this nice bullish engulfing above our previous area, above our resistance. That is an indication that, hey, we could be pricing higher. What I would want to see is a resistance broken, which happened right up here. We got the resistance to get tapped into. We did reject it, so we didn't quite break it. That rejection, could have led to something else. But if we threw on something like a Koze cross, I already know that this would have been a retest of this EMA, and we would have been able to take advantage of this buy opportunity off of this bullish engulfing, right? Because we retested the EMA, we're above our area of liquidity, and we got a market above our market bullish engulfing. We got our candlestick pattern that gives us our entry, and that would have been a beautiful opportunity to get in for the buy and capitalize off of 400 pips. Now we also got this called out for Koze cross and Koze, like everything called it out. We got there's no way you could have missed this trade buy signal, but just to kind of give you guys an example of the liquidity void and how you can use that to your advantage. Right. All right, so cool. And we're gonna FEG versus liquidity void. I feel like we already covered that. Institutional order flow entry drill, or IO Fed, right? This just means that the market came less than 50% of the fair value gap. So essentially you have your 50% of your fair value gap is going to be your consequent in encroachment or your mean threshold. And then your IO Fed is going to be when the market kind of just taps into that area. And you've seen this, I'm sure you guys have seen this time and time again if you've been trading. You've seen where this has happened, right? You have a fair value gap, You're anticipating, hey, I want the market to get back to the resistance, or hey, I want it to fill this fair value gap, then I'll get in. And the market just does just a little tip and then melts, and then you never get into your trade. And you just watch the whole thing just drop, and you're just like, God damn, I knew I should have sold. All right, how much times does that happen to people? So let's call it an IO Fed, right? Let's call it institutional order flow entry drill, right? And then we're gonna get into trading the fair value gap, right? So this is the meat and potatoes. We're gonna get into trading the fair value gap, and then right after, we are gonna get into the trend line strategy, and that's going to conclude our session for day two's bootcamp. So fair value gap, right? Trading the fair value gap once sell side or buy side liquidity has been collected, we anticipate reversals, retracements, or continuations, right? So like I said over here, this would have been an example of what? This would have been an example of, well, this one wouldn't have been. This one would have been though. This would have been an example of a sell side liquidity getting swept. I want to use this one, it's a little bit better. So we see that this is a support area, right? So this is a sell side liquidity is going to be right below here. We see that that area was swept. And after that area was swept, what are we looking for, right? We're looking for reversals, retracements, or continuations. So after we sweep this low, are we reversing, which means going up? Are we continuing, which means continuing lower? Or are we looking for a retracement? In this case, we have a complete market reversal, right? We're able to see that and able to take advantage of that only after the market gives us an indication, breaking above our EMAs, and getting outside of this liquidity consolidation zone, which doesn't happen for a while. So that's just patience, right? We see that the indication happened over here, but we wouldn't have been able to properly get in for a trade until over here, right? Maybe even up here. So that would have been hours later. If even in the next session, that would have happened, right? Because we set this liquidity and we never came back lower than this area. And then we continued pricing higher to break resistance. This break of resistance is what gave us our indication that the market can continue pricing higher. So it's all about understanding directional bias. That's all that we're doing, right? So we're using fair value gaps to help us understand that directional bias. So, oh, I didn't show you guys the fair value gap. I'm sorry. So the fair value gap was right here. We had a fair value gap right here, and that is what we tapped into, this fair value gap right there. Tapped into it right there, and that's when we were able to collect that sell side liquidity, tapped into that fair value gap, and reacted to the upside, giving us confirmation that, hey, we could be pricing higher, and we're able to take advantage of these trade setups. So for FVG trading specifically, the focus is going to be on reversals. So that's typically what I just showed you guys, this reversal pattern right here. That's typically what we're looking for when it comes to FVGs. Now, sell setup, when price collects buy side liquidity, BSL, we anticipate a reversal, right? So buy side liquidity is up here, is going to be above around where your resistance is, and your sell side liquidity is going to be below around where your support is. So sell side is support, buy side is resistance, right? Now, if we collect our buy side liquidity and then we form our FVG, that's when we're looking for the market to continue lower. Make sense for everybody? And then the exact opposite for our buy setup, right? We have to collect that sell side liquidity first, and that is exactly what we did here. Is we collected the sell side liquidity and then we priced higher, right? And that basically brings us to the conclusion of our session for fair value gaps. So we want to pay attention to a few of these areas. I'm going to kind of skip over this because you guys are going to have this PDF as well to go through. So I'm going to skip over reading all of this because I want to make sure that I cover this trend breaking strategy as well for you guys today. So I assume we have no questions on FVGs so far, and I'm going to dive into trend breaking strategy. So getting set up. Trading should be simple, right? Not stressful. The trend breaking method strips a trade reversal down to a short checklist, right? So you're going to identify a trend, same as the calm method. You're going to first identify a trend. You're going to confirm the break, and then you're going to enter with a defined stop loss and target. No guesswork, no second guessing, or you know, exiting your trade mid trade or re-entering another position mid trade, right? No more of that. We take out that anxiety out of the market when you use these setups. So the three indicators that you're going to be able to use for this trend breaking strategy is going to be your MACD, your SMA, and your EMA. And these are just three indicators that you can use in relation to Koze as well. So you can use them as confluence or extra confluence. Now, in our technical analysis yesterday, I did have our MACD and relative strength index, our RSI, here for you guys to be able to read through. So if you don't know or don't understand these indicators, definitely give this a good read. But we're gonna be going over how to use them and how to use these tools with Koze as well. So 3 time frames, you're gonna do a top-down approach on the 4 hour, 1 hour, and the 15-minute time frame. That is how we're gonna be looking at these trends. So the first step is gonna be identifying a trend, right? That is the first step. So you're gonna switch over to the 4 hour and the 1 hour, either or, and you're gonna look at the trend of the market. You need to have 3 touches first. 3 touches in order for it to be a trend. 3 touches of support or 3 touches of resistance. So when I went over here and I showed you guys something like this, right? We have 1 touch right here. We have 2 touches right here. And we have our 3rd touch right here. Now this is going to be our valid trend. Now all we're doing, well, this is on the 3 minutes, so I'm just showing you guys on the micro because you can use it on any time frame. You want to use it on the higher time frames to get your directional bias, and it's going to be a lot more accurate. But even on the smaller time frame, I'm still going to show you guys how you can take advantage of this. Same thing, right? 1, 2, 3 setups, 3 reactions. I'm going to do another one for the downside so we can see both at the same time, because might as well, right? If it's both in the same area, I might as well show you guys both at the same time. So this would be an example of 3 reactions off of support. And this is going to show you guys also what we call a squeeze or a flag pattern. Squeeze or a flag pattern. When prices basically has lows, highs, and then lows, highs, and then lows and highs, and it's getting squeezed. It's getting smaller and smaller, right? This is perfect for breakouts. So what we see first and foremost is we see that the market broke below, and then we're waiting for 3 candle closes. If we can get 3 candles closed below, alhamdulillah, that is our entry point. We take this entry, right? That is the sell entry. We have support, tap, support, tap, support, tap, support, broken. 1, 2, 3. You know me. I enter for all the eyes to see. And then we have a 1, 2, 3, resistance top, resistance top, resistance top. We did not break above. Look at this amazing rejection. We got a 4th one. We got a 4th rejection, right? But as soon as we actually did break above, 1 candle above, 2nd candle closed below, no valid. 1 candle above, 2 candles above, 3 candles above, valid. Entry, and you see how the thing go, right? So this is a perfect example of how you can take advantage of those 3 top trend break strategy, right? 1, 2, 3 touches, we get 3 candles below, and then we get our sell. So it's a 3 and 3, 3 and 3. right? So diving back down a little bit lower, identify a breaking point. You're going to drop down to the 15-minute to identify the breaking point. Ideally, if you do, most def, bro, take care. If you do use top-down analysis, you're going to identify this trend on the higher time frame versus the 3-minute, like how I did. And then you're going to be dropping down to the 15-minute to actually get your 3 candles above, and you're going to get your entry from there, right? So this is going to be also, you can use your MACD and your RSI to see when it does cross, or your EMA and see when it does cross. Your Koze cross has the EMA already. We just don't have a MACD. So you might have to put a MACD indicator on your screen, but we do have the Koze cross where you can see that cross line. And then we're going to be able to see once we break our trend line and we're above our cross. If you have a MACD, then that's just an extra confirmation, and that gives you more confidence in getting into that buy signal once you get your 3 candle closes, right? So Koze Pips directional indicator, it's going to show you that regardless. So you're going to be fine. You're going to get your trade signal entry, your take profit levels, and your stop loss levels. So everything is set there for you, and removing the guesswork. Now, 3 is going to be identify a point of entry, right? So identifying the point of entry is going to be that 3 candles above, right? With these are the 4 kind of rules, right? We want to see the SMA or the EMA cross, which Koze has that Koze cross. When we see that, that's perfect. We'll get a blue ball. When we get our blue ball in this case scenario, that is going to indicate that, hey, we should be seeing the market price higher, right? And then we get our MACD cross. That's just an extra confirmation. It's not really necessary, but if you want it, you can use it. And then we have price below or above our trend line. In this case scenario, we need to be above because we're looking for a buy opportunity. And then we have our 3 candles close on the 15-minute, and that is our entry model, right? Why we wait for 3 candles? A single candle poking past the line is often just noise. 3 consecutive closes past it is what separates a genuine break from a false one. The simple discipline that makes a level worth trading is in the first place, or the same discipline that makes a trade worth trading. And then step 4 and 5 is going to be obviously stop loss and exit, right? So we want to make sure that we are properly analyzing where we're placing our stop loss and where we're placing our exit, our TP, right? And we've gone over this already. So in your TP areas, you're going to be targeting those previous daily levels or your areas of liquidity. And in your exits, you also can exit if the market retraces back to your EMA. So those are going to be the ways that you exit out of those positions. You can also have a set 1 to 3 risk to reward. So risk to reward ratios are very crucial as well, because they help with your long-term profitability, right? And then these are just some examples of uptrend breaks and some more trend breaking, but we already went over that. This is an example of a sideways trend break that I just showed you guys on the live market as well. And that is how you're able to get those setups, right? Pretty much brings us down to the bottom. This concludes our trading on this trend breaker. So the trend breaker method is simple and reliable precisely because it removes the guesswork. Follow the rules. Don't let hesitation talk you out of a valid setup, and don't force a trade onto a pair that doesn't meet the criteria. Move on and find one that does, right? Another rule of thumb that we see is risk no more than 2% of your account. This is just something that most traders say. Personally, I'm not gonna lie to you guys, I risk about 10%. I'm a risky trader. But you guys know that for those of you who've been following me. So, yep, that is where we're going next is going to be obviously just confirm and alignment. That is the 2 that we have been kind of covering for the past 2 days, is understanding how to confirm your bias and understanding how to align your entry with that bias. Now, in day 3, tomorrow's training, we are going to go over how to lock in your trade and manage your emotions. This is going to be day 3, the final boss of trading. Today was more about risk management, understanding how to place your stop loss and when to take profits and all of that stuff using the tools that we have available for you. And then we're going to learn how to lock into the trade and how to manage those emotions while we're in them. So that basically brings us to the end of today's session. Hopefully you guys got some value. Hopefully you guys got some insight. Let me know if you guys had a good session, if you guys learned something. And I'm going to show you guys one surprise for those of you who stayed until the end. So we have our official website, guys. We have our official website. Welcome to the flock. We have our official website up and ready, where we have our moving signals forward. We have built for precision. This has been something I've been working on. This is why I've been so quiet inside the groups. It's because I've been working on this. I'm not sure why it's not showing, why it's not displaying the pictures right now, but we can see, everything is here. We can see our indicator. Our indicator access is going to be here as well, right? You can see pricing. Pricing is going to be here as well. So everything, your access, what you're going to be able to access, everything is here for you. So excited to be launching this. This is going to be something I'm going to be talking about a little bit more tomorrow, but I just wanted to give you guys a quick little sneak peek on what we have to come. But appreciate you guys staying until the end of the call. Let's continue to run it. Let's continue to take this to new heights and continue to lock in on these trade setups. Take care, guys. Enjoy the rest of your day. Peace, love.